Well, good evening and welcome to this live stream on the 27th of December 2022. Martin North from Digital Finance Analytics here. Great to have her on the show tonight. Thanks for taking some of your Tuesday out to share it with us. And as always, we're going to have an interesting conversation. Just before we bring Leith in, let me just make the point we're not giving specific financial or legal advice. We do moderate the stream, so please feel free to use the chat, but just bear in mind we do moderate it. 27th of December, of course, it's on tonight. And if you'd like to make a comment, use at Walk the World to get my attention. Or indeed, if you want to make a contribution, feel free to do that. Or, Super Chat's enabled so you can get your questions to the top of the list. And all contributions are greatly received. It helps just to cover some of the costs of what we do here. Anyhow, without further ado, let me push this button. Hi, Leith.
G'day, Martin. Hello, everyone. Good to be here.
Thank you very much for coming on and taking time out from your holiday to share it with us. I really appreciate it.
That's all right, mate. It's a stinking hot night here in Melbourne, so it's probably good to be indoors, to be honest with you. It's we're about to get our hottest night for 4 years, I think it is. But that's why I love it. I've got almost a Hawaiian shirt on. I'm wearing, you can't see it, it's off camera. I'm wearing board shorts and barefoot. So that's my favourite dress. So I'm a happy guy.
Excellent.
I'm just missing a few beers.
Well, yeah, you can have the beers later. I prefer it not while you're actually on the show.
Yeah, it's been a messy festive period so far. So I'm on the waters tonight.
Excellent. Well, look, it's great to actually have you on. And you published a post on MacroBusiness quite recently about the quote property recession unquote. I have no idea what a property recession means, so maybe we should start there. But on the way in, for those who may not know you, just to give people a bit of a background as well, because of course you've got a bit of history in terms of economics and all sorts of things as well, which people probably need to know about too.
Yeah, all right. Well, so I'll give you the 30-second summary because otherwise people will fall asleep. Basically, studied commerce, Melbourne Uni, did honours in economics, so basically an economist. Did a few jobs before working at the Australian Treasury for 3 years as a senior economist, and then went to the Victorian Treasury as a senior economist before going to Goldman Sachs, where I worked for 5 years, not as an economist, but as like a regulatory capital guy who assessed bank loans and capital against bank loans and all that sort of stuff. Before starting up MacroBusiness with my partner in crime, Dave Llewellyn-Smith, and another guy, Simon, who left years ago, and Chris Becker. And that's been going on that's going to 12th year, I think, 12th year full time, where I've pretty much been writing, I don't want to count how many articles, probably 50,000, maybe 70,000 articles over that 12 years on economics, property, et cetera, et cetera. So also chief economist at Nucleus Wealth, which is sort of a joint venture we've got with them on the MB fund. So, it's been a good journey, been a great year content-wise. 2022, heaps to write about, lots of obviously angst in the markets, property values falling. It's, if you're an economics guy, you've had a federal election, we've got an energy crisis, global recession pending, blah, blah, blah. It's been a very interesting year, but also a crappy year as well. So anyone who's got a mortgage is feeling it. Anyone who's trying to rent is feeling it even more. And it's obviously we're having a bit of an inflation crisis, not just in Australia, but all around the world. So it's been a tough year, and I think next year's going to be pretty tough as well. So no doubt we'll talk about that.
Yeah, and it is worth underscoring, isn't it, just how quickly things have changed. Because the first rate hike in Australia, well, it was May, right?
Yeah, that's right. So basically, if you go back a year ago, and we wrote so every year we do this like Christmas special report where we look ahead. And the last one was sort of positive in the short term on the Australian economy, but negative in the long run because the last was actually ended up being bang on right in this respect. I basically said in the last one that if we go back to the big Australia mass migration model that we ran in the previous 15 years before the pandemic, we're going to have another lost decade, which is basically like what we had in the previous decade, where the economy grows because we're getting more people, but everyone's share of the pie basically doesn't grow. And then once you factor in all the other negatives from traffic congestion, living in apartments instead of houses, and all the other lifestyle stuff, we called that a lost decade and sort of predicted that we're probably going to get another one based on the government going back to the same stupid policies they did before. Obviously, nobody foresaw Russia invading Ukraine, which set off obviously the global energy crisis, helped push up inflation everywhere, and then obviously now the central banks in an arms race to hike interest rates in the most synchronized manner I think I've ever seen in my lifetime, at least. I don't know if they did it previously like that, but so now we've got a global energy shock where energy prices are rocketing everywhere except smart places like WA, and then we've also obviously got central banks hiking interest rates, very hard, and we're staring at a global recession next year. So things have changed, done a 180 in a year really, and it's caught everyone off guard, and I think it just showed you how reliant the world is on each other. So you've got one rogue state invades another place. That rogue state happens to be a major energy supplier, and then the sanctions come in, etc., shuts off that tap, and then it just causes energy prices everywhere to rocket. Even for countries that weren't relying on that in the first place through second round effects. So it's been it's been one from left field. So hopefully, obviously. Being annoyed about rising energy prices is one thing, but obviously if you're a Ukrainian, you've got family over there, which one of the guys I box with is actually Ukrainian, and it's an absolute bloody terrible situation they're in. So there's obviously the human element there, which has been absolutely shocking too.
Yeah, and there's an interesting conundrum here as to what extent the inflationary impulse that we've been living through was created by Ukraine and energy, right? And to what extent it was actually already wired in because of the last 20 years of bad policy, because of the COVID cycle of stimulus, the term funding facility, ultra low interest rates. My thesis, until proved otherwise, is that a lot of it's actually wired in, but it was exacerbated by the Ukraine cycle. However, even if the Ukraine thing hadn't actually taken off, inflation was already starting to ramp up.
Yeah, and we would have had higher interest rates. I just think it's probably way steeper and worse than what we would have got otherwise. So I think it's one sort of reinforcing the other. Then it's definitely been exacerbated greatly. So instead of having a kind of a more moderate hangover, we've got the hangover for the ages.
Moderable hangovers.
Yeah, that's it. So it's pretty nasty.
And I'm going to put this slide up. This is one of the ones you sent through, right? The synchronized central bank tightening means global recession, right? I think this degree of synchronization, I don't think I've ever seen it.
No,
before,
right? Absolutely not.
I mean, this is a big deal.
Yeah, it is, and usually I think you might get one or two countries doing it or whatever, and then another country might follow years later, but not in this manner. Literally, obviously New Zealand was first, so New Zealand started hiking. I think in September last year was their first hike, but the rest of the countries have really just been this year, and amazingly, Australia is actually not near the top. New Zealand's at the top, followed by UK and the US, and so those countries have been more aggressive than us, but at the same time, Australia's arguably more sensitive than any of those other countries because we've got much higher household debt, and we've also got a higher share of borrowers on floating rate mortgages. So that means that obviously we're more sensitive because people got carrying more debt, and also means that when the RBA hikes interest rates, it flows through to mortgage holders a lot quicker than those other places. So although we haven't hiked as hard, it's Australian households are certainly feeling it way more than US households who are carrying about half the debt loads, and a lot of their huge chunk of their mortgage holders are on 25-year fixed rates.
Interesting to note, of course, in the US, wages growth is stronger than here as well.
Oh, yeah. So Australia's sort of an outlier in that respect. So US has had, I think it's 7% plus wage growth. New Zealand similar. So pretty much everywhere is having, and UK's had very high wage growth. Obviously, their inflation's higher, so they're still going backwards in real terms. But in Australia, we've got wage growth of, was it 2 points? Geez, you can tell them on holidays because usually I just go bang. So the 2.6% was the last one. No, sorry, 3%. 3%. The last, September was 3% or 3.1. Oh man, this is, I got to be really sharp tonight because I've turned my brain off for 4 days.
That's okay.
And when you do that on holidays, you stop.
All control delete,
like,
you know?
yeah, that's it. Then you come back next year and all sort of gets rebooted. But yeah, so Australia, I think it was 3.1% in the September quarter, and that's less than half the rate of headline inflation. New Zealand, they got a couple of different measures. One of them was about it was actually above the inflation rate, 7.5%. Versus their wage growth versus their inflation rate is about the same as ours, about 7.2. So we're a bit of an outlier that we haven't had the wage growth that these other places have had, which also arguably means there's no evidence of a wage price spiral here, like there is in other places.
And it's worth noting that in the latest US numbers, it's the services inflation.
Yeah, which is really, the more demand driven.
Yeah. Demand driven and wages driven, because in services there's a lot of people, right? Yeah,
whereas Australia's goods driven inflation and so mostly imported, weather related, supply side, and whereas our service inflation is actually not that bad, and it's because the wage growth's low. So services is about 80% of the Australian economy, and that 80% we don't have bad inflation. But it's all the imported stuff, the weather related stuff. Obviously, this could all change, and I'm sort of hoping it doesn't. I think a lot of that other inflation is going to ease off in the next. It's probably every economist will say, it's going to peak in the December quarter. So it's peaking right now, and then it's going to come off. That's the consensus view. So when they when economists do the forecast, every time the ABS or the RBA puts out a release, you go to a place like Forex Live or whatever, or Bloomberg, but we don't have Bloomberg, and they'll give you what consensus was. So this is what a survey of economists thought was going to happen, and then they compare it to what actually happened. And the consensus at the moment is that the inflation is going to peak in the December quarter. So basically, the quarter that's about to end in a few days. So now, and after that, it should fall. But yeah, hopefully we don't start getting the services inflation, which have been it's more entrenched. But we won't know until the March quarter comes through, and the way that CPI is so lagged, we'll know in about 4 or 5 months or something. So,
I was going middle of next year. We should get a feel of where we are. Right?
Yeah, although there is the monthly inflation gauge, which is useful, but that doesn't include energy. So it's
there's some really interesting things about the monthly, right? It's not a full measure, right?
Yeah, it's not. It doesn't include energy or utilities. I think it is
correct,
which is pretty important at this time when you got energy problems on the East Coast.
And they also did a little bit of rebaselining, so that effectively the numbers also, about half of the inflation movement last month was actually to do with rebaselining.
Yeah,
So
that's right.
So there's a few funnies in there, but of course a lot of the commentators didn't pick up on some of those.
No, I must admit I didn't, because when the data release comes out, you get the monthly one, and it comes out at 11:30, you have it up by 11:35. So it's like, you just do it quick. Especially, I was working at my own at that stage, I think, and Dave was away, so I was just like pumping out the content. And and then it was later on, it's like, oh, okay, cool. And I think it was 2 days later or something, I realised, oh, hang on, they've actually changed this. Yes. But there's already old news. So,
and it's very interesting that they've actually reduced the weightings for housing and rent.
Yeah, they did. That's right. And so that's interesting. And it's backward looking, because when you actually read that, I think did this come out last Friday? Yes. Boxing Day? Christmas Eve. Just
before Christmas. Yeah.
Yeah, that's right. Yeah, I think it was
almost. I wonder whether they did that deliberately.
It's almost like trying to put it out the trash. So in the US, they use a term, we'll put it out with the trash. So they put something out Friday afternoon, is usually when they do it, when nobody cares. And it was like that almost happened, because I must admit I was ready to wind up for the year, and I just had a quick glance, and I'm like, because being a property dude who pumps property articles out every day and follows it really closely, I went straight to the property way, and I'm like, what? It went down? And the reason for it was that the rents fell. And it's like, it's kind of circular, because the ABS rent measure is so lagged to the actual market.
Yep.
So, for example, the September quarter CPI for rents, by memory, was about, I think, 3.1% or something. And so it was less than half the inflation rate. And, sure, it's rising because, it started to rise. But if you go to all the market measures, so whether it's CoreLogic, SQM Research, who's actually the highest, or Domain, or any of these other ones, they got double-digit rental growth. So CoreLogic's actually the most modest out of the private sector ones, and they're showing 10.2% growth nationally. And across the capital cities, it was, I think, 10.8, which is the ABS only measures rents in the capital city. So CoreLogic's showing 10.8, SQM's showing like 18% or something, and Domain's, in between that. But then you got the ABS showing 3.2, I think it was. And then the ABS has reweighted the CPI and reduced the rent component of CPI based on this old data that's already been superseded by, a year ago, really, if you look at the market.
Correct.
So it's kind of stupid. So in about a year's time, when hopefully the rents are, well, they probably won't, but say in a year's time, the rents have started to come back down to normal. When the ABS does the weightings again in a year's time, they're going to be ramping up the rental component because they'll be a year late. So yeah, it's just one of those, quirks, statistical quirks that we get.
Well, I talk about number weighing, right? This is there's a lot of number weighing goes on, but this was a really interesting one because again, a lot of people didn't pick it up, but it's not really that robust. And the point, of course, is the difference between new rents, so effectively property that's currently advertised, versus the sort of historic rents of
across
people.
The market.
Exactly, and that's part of the confusion. And by the way, it's also the same confusion as in the US. The US have the same problem at the moment between those two metrics. Yeah,
and of course the advertiser rents are leading. So all the leading indicators, if you use the private providers of advertiser rents, have been rocketing for a year.
Yep.
But the ABS is looking at the whole market, and so you can see where it's going. You know that we're going to have a rental shock in the CPI in the next over 2023.
Yep.
And it's also one of the reasons why one of the arguments for running high immigration, I don't know if I'm going on this too early, but is to suppress wage growth. So they say, it's good for inflation because you suppress wage growth, you keep inflation down, but at the same time, it's going to tighten the rental market and send rents higher. So, and that's about, I can't remember what it was on Friday when they changed it, but it was about 6% of the CPI basket was rents. So it's might be, 5.5 now or something. But by the way, it's going to have an impact. And so, it's not as simple as, just put in the people, create a wage growth, which isn't really desirable anyway. And then, but you're going to get it's going to be inflationary in other areas.
So Daniel made the point, there's talk about opening the floodgates of immigration. Some who think will save property prices. My thoughts is it will do is keep wages low, meaning less borrowing power. And I think the suppression of wages growth off the back of it is definitely a design feature. Yeah,
and I think, high immigration definitely benefits property prices over the really, really long term. So if you were taking a 10-year time frame, you'd say higher immigration means higher property prices, other things equal, but it doesn't touch the sides when you're dealing compared to interest rates.
Yep.
Like interest rates is 90% of it. Not just interest rates, but the availability of credit. So the same.
It's borrowing power, isn't it? It's the availability of credit. Yeah.
That's it. Actually, borrowing power is probably a better way to talk about it. But when interest rates go up, borrowing power falls. So you go if you ever want to have a play, just go to a mortgage calculator, chuck in, $1 million mortgage, $500,000, doesn't matter. Put in, just put in interest rate and then raise it by 1%, and you can see how much more you need to service that mortgage. And that's effectively, so if you need more money to service a mortgage, that means you're, Finder put it best. So Finder did a analysis. So Finder's like a comparison site, and they did a analysis based on the last interest rate rise. And they said that a $500,000 mortgage in April before they did the first rate hike could be serviced on an income of about $125,000.
Yep.
Now, after 3% of interest rate hikes, now you need $180,000 to service that $500,000 mortgage. So what that means is for a given income, you can't borrow nearly as much. And it's about, I think it's getting close to about 30% reduction in borrowing capacity. It might be 28 or something, but it's
close to 30 now. I agree.
Yeah. Yep. So it's about 30%.
Yep.
And so, you need 125 grand previously to do 500 grand. Now it's 180.
Yep.
And that's only in 7 months. It's gone up that in 7 calendar months, which is absolutely insane. And because of that, that is the reason why property prices are going to keep falling. Because the fact of the matter is the prices we've got are not affordable to the new generation of buyers. So at prevailing interest rates. And, before the pandemic hit, during the pandemic, like last year, sure, first-time buyers could only get in if they borrowed to the hill at 2%-ish mortgage rates, or really low mortgage rates. Only then was it affordable or possible to buy. Well, obviously, if you're going to have mortgage rates that are 3% higher, well, sure, property prices have fallen a bit. They haven't fallen nearly enough to bring them back into the game, and that's why they've got to keep falling until that borrowing capacity. Now, there is some stuff that could happen, like APRA could kill the serviceability buffer. So
3%, way too high. Rates will never go 3% above where it is. Let's take it down to 2%.
Yeah, or 1. Now, who knows? I mean, it depends how aggressive you want to get. But the scary thing is that anyone who took out a mortgage, I think it was November last year. You know this, Martin, better than me. But when APRA was assessing mortgages at 2.5% above the prevailing rate. So if you're buying a fixed rate at 2%, you'll get assessed at 4.5%. I think, was it November, or it might have been in September or late last year. So it was late last year. It came in an exact month. But APRA, because they saw the bubble, the prices rocking.
Finally, they saw it.
It was risky. They go, geez, property prices going up, bloody whatever it was, 25% nationally and 40% Brisbane and whatever.
Yes.
Or 30%, I think it was. They said, that buffer's got to be raised to 3%. But the scary thing is, there was a ton of mortgage people who took out those cheap rates.
Yes.
Mostly first home buyers were, really aggressive.
Massive peak.
They're assessed at 2.5%, and now it's already gone above what they were assessed at by 50 basis points.
Yep.
Which is pretty scary, and it's the most scary for, say, 2/3 of mortgages that were taken out last year by first home buyers were at fixed rates. So we had this fixed rate mortgage boom because it got so cheap, and about 2/3 of those fixed mortgages that were taken out, 2-ish% are going to be refinanced in 2023. So when anyone hears about this fixed rate mortgage cliff, it's all over the news. That's what they're talking about, where you're going to suddenly, these rates are going to expire. They're going to be reset at, you have to refinance, and you don't have to necessarily refinance, but you're going to revert to a variable rate, which is going to be 5 to 6%. And that's a massive increase. You go from 2-ish to 5 to 6. You get a massive step up in repayments. And if you're one of those first home buyers, like a first home buyer by definition doesn't have much equity in the home, they're going to be probably, a lot of them going to be negative equity because prices have fallen so much, especially if you bought in Sydney, Melbourne, and Brisbane last year. And then you're going to be facing a huge increase in your repayments. So, and the scary thing for those people is, if you're with a lender who you're not happy with your rate, like say they're charging, you can get a way cheaper loan elsewhere, you're not going to be able to switch because you're not going to meet the new serviceability requirements, which is 3% above the prevailing interest rate. So if you try and switch lenders, you're going to be assessed at about 9-ish% or 8 or 9%. And if you're in negative equity, they're not going to take you because your property is valued. So you're going to be captive to the lender you've got, which mightn't be the best lender out there, and they might be gouging you. So it's kind of, it's a pretty scary situation, especially for those first home buyers who, had the FOMO last year, got in, anywhere mid-ish last year to late last year, especially just before the peak.
When Michael Zucker was encouraging everybody to buy him property,
Yep. And then, of course, Phil Lowe was saying, don't worry, late rate's going to be low for, 2024, blah, blah, blah. So, they're going to be the victims, the ones who are hurt the most. And then on the other flip side, those who didn't buy, who are renting, are going to be the other victims because rents are obviously rocketing, and it's a pretty crappy situation for those people.
So just on the underwriting, there's a couple of things that's worth adding. Banks are now prepared to extend for a loan for a longer period of time. So one of the conversations which is going on is 30 to 40 year loans, right? Interest only loans that you can pay from your superannuation when you retire. That's another conversation that's going on.
Yeah.
Also, some of the banks have actually reduced some of the haircuts. So, for example, NAB adjusted the investor from 80 to 90. In other words, 10% haircut rather than 20% haircut on rental streams. So the banks are sort of trying to sort of do all they can to sort of accommodate these new tighter conditions. The other interesting observation, which is that the banks were making assessments of the cost side serviceability based on the HPI, the standard formula, But that was before inflation started raging, right?
Yeah.
So effectively now, not only have you got this pincer movement with higher rates, but you've also got the other cost of living rising as well.
Yeah, it's rocketed.
So that's another factor that isn't fully actually being appreciated at the moment. So the base assumptions on the cost side of the equation, they've actually changed them quite recently and lifted them. So again, another reason why people who made those decisions a year plus ago are off key. But interestingly, one or two lenders are actually prepared to take people onto their books on the old assessment that was done by the previous bank rather than doing a new one.
Yeah.
To avoid all of this drama.
Yeah. So they're sort of jigging the stats.
Yes, they are.
Yeah. Well, just on that's an interesting point because the RBA did some modelling recently, and Chris Joy has written about it a lot. He did some good analysis on it, and basically they found that at a cash rate of 3.5% under their modelling, 15% of all borrowers would be in a negative cash flow position. So the way they measured that was they said they looked at their debt repayments and their sort of their necessary spending. So I'm not talking about buying a TV you don't need and going to, this is basically your subsistence spending. And they found that based on a cash rate of 3.5%, so mortgage rate is 3.5% higher than it was in April. If you're on a variable rate, 15% of them are going to be negative cash flow. It's going to be basically spending more than they earn, which is which I'm sure your modelling says a lot of the same stuff, but it's pretty scary. So this is actually coming from central bank, and then it's scary when you think that they know this, but then they're probably going to roll the dice and do another rate rise. It's interesting time, and I bet you a lot of those people are going to be those first home buyers we're talking about who bought, or recent buyers, especially the first timers, because if you're an upgrader, you've sold a house probably for profit, you've got equity, you're not in as precarious, more likely to be my age, for example, where you've got more income behind you, and et cetera, et cetera. But if you're like a 30-year-old who's, it's your first dance, and you really stretch yourself to get in because that's what you had to do. The only way you can afford a place. Those are the ones that are going to get hurt the most.
It's worth reflecting also that quite a few of those people who got in with help from Bank of Mum and Dad.
Yeah.
Bank of Mum and Dad used equity out of their property, and now the value of their property is also going down. So that's the sort of the second order impact of some of these changes in property values, which hasn't again been reflected on, I think, to an adequate amount, because of course the Bank of Mum and Dad assumed that property prices will continue to rise and they'll have enough when they move into retirement. Well, suddenly maybe they won't. So there is a very significant connection point between some of those first-time buyers, but the Bank of Mum and Dad is also in difficulty now as well, and I see that in my survey. So.
Yeah, for sure, and it's worth pointing out that the rate rises we've seen since the 3rd of May, I think it was, that's unwound 10 years of interest rate cuts. So we've reversed 10 years worth of interest rate cuts in 7 calendar months, which is extraordinary. And get back to the RBA modelling, they said that by the end of this year, so basically now, came out a month or so ago, based on the cash rate at 3%, that the ratio of mortgage repayments or household debt repayments, the household income is going to be an equal high to what it was, I think, back in 2008.
Correct.
So any further interest rate rises after this are going to push it above it. And in fact, they'll probably go above anyway once the fixed rate mortgage reset happens anyway. So even if the RBA does no more rate hikes, we're still going to get tighter monetary conditions next year because we've got this big reset of fixed rate mortgages. I've actually got a pretty good chart in there. I don't know if now's the time to bring it up, but actually shows in a chart. It's on 1, 2, 3, 4. It's the monetary conditions are tightened further.
Hang on, I'll just bring it up. Here you go.
Yeah, so this chart on the right side there, what it shows is that blue line is basically the share of total mortgages that were taken out at fixed rates. So I said earlier that Australia's got the highest share of fixed rate mortgages, variable floating rate mortgages in the world, which is, one of the highest, but not the highest. I think Norway might be a bit higher, but certainly the Anglo countries were the highest. And that's despite the fact that the historical average of mortgages that were fixed, so 1 to 3 years is usually the fixed rates, used to be 15%. It was 15% up until the pandemic, and then it suddenly jumped to a peak of 46%, sort of mid to late last year, when the fixed rate mortgage rates tanked to about 2%, and now they've obviously fallen away as fixed rates have gone up. And for first-time buyers, it went from a long-term average of 25% of new mortgages were fixed up to 66%, 65%. So I didn't put the first-time buyer chart line in there, but it looks almost identical, but it's just higher. And all that says is that even though the RBA has hiked rates by 3%, it's super aggressive, there's a whole big chunk of borrowers that are yet to be impacted because we had this rush on fixed-rate mortgages. And those people are waiting for D-Day, and about 23% of mortgages by value next year, so 23% of the entire mortgage book of Australia by value, so not by number, is going to refinance, is going to basically refinance next year because the pig in the python is going to roll through. So these fixed rates that boomed in 2020 and 2021 are going to expire next year. And those people, as I said before, are going to reset from 2-ish%, maybe 2.25%, up to 5 or 6%, depending on how hard the RBA goes. So, monetary conditions are going to tighten massively next year, even if the RBA does no more rate hikes, just because of the fixed rate mortgage reset.
No, very good point. And there was an IMF report that came out. In fact, it was reported in the Age today. Australia's misaligned housing market at risk of major crash as rates rise, says the IMF. So wow. Property prices in Australia may be as much as 50% above what an average household can afford as interest rates rise, a global analysis has revealed, while warning the market is at risk of a major crash as interest rates are pushed up to bring inflation under control. A report...
Yeah, I didn't read that. I've been on holiday. So,
no, that's fine. That's why I'm reading it out, because I think it's really interesting. A report on housing stability and affordability, the IMF fund said Australian property and rental markets were some of the most misaligned in the developed world. And they went on to break it down. So, for example, they showed the housing debt and how much it's climbed. And, Australia's in first place there, comparing 2007 to 2021. And they also looked at housing affordability challenges and what effectively is going to happen in terms of the debt to income ratio, debt service to total income. And it's interesting that they are talking very much about serviceability, so not gross income, but actually real disposable income. Right. Yeah. Which is the way that I look at it, because I think that's the only way to look at it. So whilst you can have a theoretical ratio of your total gross to, what the debt is, that's really meaningless. You actually have to look at the real disposable income. And when I do that in my modelling, there are people now at 30 to 40 or more than 40% of their current disposable income going to pay the mortgage. And that's before the latest impacts of those rate rises you're talking about on the fixed rate movement. So it's already looking pretty bad. So it's interesting that the IMF's come out with that. And
it's also worth noting that if you're on a variable rate, it's still very lagged. So I've got a mortgage with Macquarie, and luckily not a big one because I'm old. Not old, but I'm 45.
It's all relative, I can tell.
Sorry. No, but I mean, one of the benefits of being older, so I'm 45 in a couple of weeks, is that bought my place in 2006. So had a long time. So the mortgage is not much now. But despite that. I finally got notified a couple of days ago. I think it was Friday. As usual, they put it out in the trash just before Christmas. Got this email and it said, your interest rate's going up. And you get these I've been getting these every month, but it's amazing how lagged it is. So the RBA hiked it in December, early December. I finally get the email towards the end of the month, but it's not coming into effect till like late next month.
Yep.
So it's like really late. It's quite lagged. And, Gareth there at Commonwealth Bank, said that for CBA, it's like about average of nearly 3-month lead time before when the rates go up and when it actually hits mortgage holders. Yep. In some places, 2 months, but 2 to 3 sort of seems to be the average. So, there's still people who are still waiting to get hit for the November rate hike or about to get hit by that. And then the December one's going to hit in January or February, depending on what your lender is, or maybe even March if they're really slow, or early March. So the full impact even on variable mortgage rate holders hasn't been felt yet. So it's still working its way through the system. So, it's another reason why it's going to tighten, even if the RBA does nothing else. So for variable rate holders, it's going to take a few more months to even before they're paying the maximum amount that they should be paying.
Yep.
And then obviously the fixed rate mortgage resets the big risk.
And it's interesting because Roy Morgan came out with their mortgage stress data, and they showed a bit of a peak. Right now, they measure mortgage stress from a sort of an underwriting point of view, so it's more looking at it from the lender's point of view than I do. But they're seeing a peak, and of course, my own modelling is also showing that there's a considerable spike. So we've got more people now struggling with the cash flow implications of trying to make the mortgage repayments. But again, there's a lag between that and people falling over.
Yeah, for sure. And look, I know it anecdotally. I know people who've been who are like they're not panic stations yet, the people I know, but there's a few who are concerned. A couple of them are going from fixed to variable, so they're like, oh god, they know it's coming in the first quarter next year. One of them, and another one by about May, I think. But also some other people on variable rate mortgages are already getting hurt. So, one of them who feel sorry for them. They lived in a 2-bedroom apartment with some kids. They sold in 2020 because it was just too cramped. Just trying to work from home with young kids under 6, 2 young kids under 6. And they sold their place. They got more than they were expecting. So like, oh yeah, cool. But then underbidder they just kept missing out while the prices were going up, and they finally landed a house early this year before the rate hikes. And then now suddenly it's just like 3% added on because they got a variable rate mortgage, and and not the sort of greedy property speculators, just a person with a family who's now in pretty struggling financially, and not the sort of person you think would struggle, just because they kept missing out, prices kept rising, they finally got in, and then obviously Captain Phil Lowe dropped the hammer on them. So, yeah.
Yes. And it's interesting because Phil Lowe, of course, I'm certainly sorry if people listened to what we said and then acted on that and now regret what they've done, which is a sort of a Clayton's apology, really.
Yeah. So, that's right. It's apology, mate, when you don't want to make an apology. But, look, I don't know. I think part of the problem was the RBA was kind of thought they should be doing forward guidance or something. Like it's, that kind of became a trend amongst central banks to try and, so the RBNZ was doing it as well. And RBNZ's still doing it, but they're now doing the negative forward guidance. They're saying, we expect a recession. We expect New Zealand house prices to fall 20% peak to trough. And basically we're going to keep ramping. They're really hawkish over there. So they've got everyone shit scared. Oh, sorry, probably shouldn't swear, but, scared out of their wits. Because the actual central bank's coming out scaring the hell out of them. So they're sort of jawboning the other way. But previously they were, the RBNZ's been doing forward guidance for years, and now the RBA's kind of fell into that trap, I think. And they did, I guess they didn't read the room. So, probably wasn't. Look, in hindsight, wasn't very smart, as we know. But, here we are.
And I suppose then, thinking about the implications, it's all now about the consumer, isn't it? It's what is the consumer going to do? And I keep saying, remember, not everybody has a mortgage, right?
No,
not everybody is in debt.
No,
but there's a lot of people who are, right? So
yeah, and it's probably a third of households are carrying mortgage debt.
Yep.
But then again, you got the other. So you got the renters as well getting absolutely hammered too.
Correct.
So they're also getting hit by soaring rents.
So it's roughly 2/3 of households, those with mortgages and those in the rental sector, are the ones who are actually going to have significant pressures.
Yeah, for sure. And when you talk about the Australian economy, like I pretty much disregard most things now when you want to look ahead, and I look at just at the consumer spending because basically where the household consumption goes is pretty much where the economy goes. And I've got a chart here that the second slide. Yeah, the one on the right is probably the best one to sort of show you the correlation. So I plotted final demand. So final demand is basically GDP growth when you exclude net exports. So it's basically the domestic economic growth. And against household consumption, you can see it just household consumption, it pretty much just follows household consumption. And household consumption is already trending down quite sharply. And this is only to the September quarter. So it's pretty old, this data. And the other thing is the chart on the left actually shows the breakdown of what drove final demand by four main components. So there's housing consumption, business investment, government spending and dwellings, which is housing. And about 90% of the growth in the year to September was all household consumption. So in a typical quarter, like on average, the household consumption drives 55% of growth, but just happened to be in the year to September, it was 90%. So pretty much all the growth we had in the year to September was all household driven. Problem with it is obviously in the most recent quarter, the growth has fallen quite sharply. And, I think we can pretty safely say that household consumption is going to, the growth is going to dwindle away to nothing next year, based on obviously rising mortgage payments, rising rents. Surprisingly, rising energy prices would still count as consumption, so it doesn't really work like that, which is weird. Like it's a big hit to disposable income, but it's still a household consumption item, even though it's a necessity. So that doesn't actually affect it directly, but because of this high interest rate environment, you can pretty much you can be fairly confident household consumption is going to get smashed in 2023, especially when these fixed rate mortgages roll over and all this other stuff. And because of that, we're going to have a really crappy year economically. I don't think we'll have a recession personally, like a technical recession. And that's purely because we're going to ramp the immigration floodgates to levels we've never seen before next year. And I'm tipping 2% population growth. So if you've got 2% population growth, it's actually pretty hard for the economy to go negative because it's got that 2% headwind. But per capita growth's almost certainly going to be negative next year. So the pie is going to grow, but everyone's share of the pie is going to shrink, which is a recession anyway, let's face it. We're going to get rising unemployment as well. So
postscript, it increases tax, of course, which is what they also want.
Yeah, that's right. Yeah, it does. It increases tax, but also that's because they don't account for the cost that's involved in obviously providing everything for more people.
Correct.
So, infrastructure and all the other stuff. But don't worry about that. That's someone else's problem. We just worry about the tax. It's just everything's short-sighted in this country. So,
and just on that, while we're talking about consumer, this is the Roy Morgan consumer confidence, right? Yeah. I mean, it's still in the gutter.
Oh, mate, I've got one. I didn't put it in this chart pack, but I've done it sort of monthly. So monthly averages all the way back to like the 80s. And so if you do it on a monthly basis, it's actually equal to where it was at the bottom of the pandemic.
Yep.
Which is the lowest it's been since the early 90s recession. So we're sort of tracking at basically recessionary consumer confidence. Business confidence has tanked as well, so that's almost recessionary. And, the weird thing about it was the consumer confidence already was in the gutter when the RBA commenced the rate hiking cycle. So, never before have they done these aggressive rate hikes with consumer confidence already bad.
Yep.
I think we can pretty safely say the consumer is going to be the household consumption is going to suck next year, and because of that, growth is going to suck. Whatever. I mean, it's to be expected. I mean, this is what the RBA wants. So,
well, the RBA has quite clearly said we've got to deal with inflation. Rate's probably going to high. It's interesting. Thanks for Brett for the super chat. Peter Schiff is claiming that inflation hasn't peaked, and we'll see a rise of inflation in 2023, and the Fed may stop raising rates and let inflation run.
It could. Yeah, I mean, easily as central banks, if a global recession comes, they could start, temporarily, just sort of, focusing on growth rather than inflation. Yep. That might become their priority, and I think that's pretty likely. There was certainly some research I put out on MacroBusiness just from, I think it was a couple of the investment banks, global investment banks, were making the same argument, saying that not so much that inflation is going to keep rising, but it could stay stubbornly higher than expected, and central banks will pivot to worrying more about growth than inflation next year, which seems fair. I mean, if it gets to a stage where unemployment's surging and there's real pain out there, well, then they might just say, look, we can just cope with a bit of inflation and worry about not hike rates or maybe even cut them, who knows, to focus more on growth than inflation. I mean, I don't know what your view is, but I think the RBA is going to cut second half, probably last quarter in 2023. I think they're going to start cutting rates.
Well, there's two observations. Clearly, all the central banks are saying we've got to deal with inflation. Look at the 1970s when we didn't. That was a major mistake.
Totally different situation.
Completely different situation.
We don't have wage price rise. We don't essentially. We don't have a powerful union movement.
Correct.
We don't have centrally indexed wages where basically they just track the inflation rate. So it's a totally different situation in that respect.
And very low levels of unemployment. So very high employment ratios at the moment. And there's a lot of arguments out there saying, well, actually, is inflation the most evil thing relative to not having a job?
Yeah,
right.
That's it. And I think that's where the argument's going to flip. Because at the moment, the labour markets are still pretty tight everywhere.
Yeah.
And if that reverses, I think the central banks will shift focus. And they'll start worrying. They won't worry so much. And then maybe it might even become formal. They might start thinking, we'll lift our inflation targets. Who knows? But I in terms of Australia, I think they're going to cut late next year anyway, because I think they're just because of the whole impact on the household consumer, like we're seeing here.
Well, it's quite clear that the household debt burden and the implications of that, for, as you said, for the consumer more generally, and therefore for consumption.
Especially once those fixed rate mortgage reset happens. So as I said earlier, the 55% of mortgages that were taken out over that sort of 2020 year, which is when the most indebted people are, because they're the most recent buyers. Just whoever bought recently is the most indebted. That's the way it works. 55% were on floating rates, 45 on variable, roughly, that year. Well, so a lot of households have actually been insulated from the rate hikes purely because they've been on these short-term fixed rates. Well, obviously, as they flip over, the pain's going to be intensify across the household sector. So that's when the rubber hits the road of the RBA's rate hikes, and then that's when they'll have to loosen, because all the impact of their cumulative rate hikes will suddenly hit over a period of 6 months. I mean, it already has hit, but just not everyone. There's a big chunk of people that have been hit, and once they're added to the pie, the pain levels are going to go up, and obviously the impact on the household consumption is going to go up, and blah blah blah, and the RBA will have to ease off because things would have tightened anyway on its own.
And it's worth reflecting on this. This is the ASX 30-day cash rate futures, right?
Yeah, it's 3.8 now, isn't it?
It's 3.8, exactly, and 3.7 and a bit in May 24, right? So it's come way back, because at one stage it was well over 4%.
Oh, mate, there was one stage it was close to, I think 4.4 was
correct,
where it got most nutty.
Correct, exactly. So it's interesting that now we've got a lower level of higher rates. And the fact of the matter is that the markets are saying it'll go up a bit, but not as much. And it's interesting that the yield curves pretty much everywhere are doing the same thing, right? So pretty much across the globe, the peak of the rate is not as high as it was. Although in the US, it's a little bit sort of more aggressive. They're still saying 4+. For the reasons that we discussed earlier on. So
I think the RBNZ's saying 5.25.
Yeah, I was going to say New Zealand is actually leading out the front at the moment. Adrian Orr is still saying we've got more to do.
Mate, so you talk about a fixed rate mortgage clip here. New Zealand's got one on steroids. So 50% of their mortgage holders go from those. Because New Zealand, despite the fact we've got the same banks as here as there, we've got the Big Four banks of Australia and New Zealand's Big Four banks. They're just... You got ANZ, obviously, but they just rebadged a few of the others. So ANZ's ANZ, Westpac's Westpac. There's ASB, which I think is Commonwealth Bank. And then I can't even think of the other one. Maybe it's National or something, but but it's not National Australia Bank. But they're subsidiaries of the Big Four banks here. So we've got the same banking system, but for some reason they've always been much more. They've been like 80% fixed rate mortgages. So, but these short-term fixed rates, anything from 6 months up to 3 years, has been the New Zealand model. Whereas we've always been 85% variable historically before the pandemic, and the rest those short-term fixed. So, despite the fact that the RBNZ's now at 4.25 and has already gone way harder than us, and they went earlier than us, their households arguably haven't been hit nearly as hard because so many of them are fixed rates. But 50% of them, according to Westpac, expire in 2023 and they get reset. So we're looking at about 23%, I think it was, of our mortgage book does a fixed rate mortgage reset. New Zealand's doing about half. So their pain still hasn't been felt, and when it comes for them, it's going to be even more intense. Yep. So I think if Adrian Orr goes to 5% cash rate or 5.25, whatever he said, and then you get this fixed rate mortgage reset, that's going to be very interesting. So, but the weird thing is, like, the way Kiwis work is because they go off the fixed rates have already risen to reflect the expectation. So if the cash rate goes to 5.25, mortgage rates might actually go up much more because it's already priced in. Whereas our variable rates just tend to follow the cash rate. So it's a bit of a different system, but the bottom line is a lot of their pain hasn't been felt yet, and even more so than us. And the rubber's going to hit the road next year for them when those half of all mortgages reset. So it's going to be past the popcorn moment, I think.
Yeah, exactly right. Well, and I know that when we do shows or content about New Zealand, we always get a lot of people watching it, right? Because in fact, the New Zealand situation is probably the leading edge of a lot of this pain, right?
Yeah, and their house prices are down 13.4%, the house price index. So there's the one that the RBNZ uses the most, and it's kind of like the leading index. It sounds weird saying this because it's from the Real Estate Institute in New Zealand. You hear that and you go, come on, that's dodgy. But they have their house price index is actually very good. So it's a bit like the CoreLogic hedonic index. So just for composition and characteristics and blah, blah, blah. That index has fallen 13.5, 13.4, I think it was, from in the year to November. So it peaked in November 2021. The data came out a few weeks ago for November 2022, and it's down 13.5% roughly. So they're already down way more than we are over a bit longer period. And their own central bank has said 20% peak to trough declines, which would suggest they're 2/3 of the way through. But some of the big four banks like ANZ, etc., they're all tipping 22.5%, 25%, like much higher falls. So, the Kiwis are either 2/3 of the way through if you believe the RBNZ, or about halfway through if you believe the others. So it's going to be a pretty big house price correction over in New Zealand. Pretty much a crash once you get to those levels. And their own central bank is tipping this, which is one of the reasons why consumer sentiment in New Zealand has just hit in December, or the most recent readings came out a few weeks ago from two different surveys, hit their lowest level in history. Yep. So the ANZ Roy Morgan and the Westpac, some other Westpac, Milford or something like that, some weird name. But the Westpac and the ANZ one, both are at their lowest ever levels. And you can see why. Their own central bank is saying recession in 2023 and 20% house price declines and, cash rate of 5.25%. If you put those three things to consumers, they're going to run for the hills. And that's what they're doing. That's what their own central bank has said. So the Kiwis are definitely one to watch. It's a market I follow pretty closely, and it's quite amusing. And the worst thing is their Prime Minister, so Jacinda Ardern, is going to go to an election November next year, seeking a third
Perfect
term.
Timing.
Oh, mate, you cannot think of worse timing to go to an election. So the last election was during COVID, and everyone loved her, and she, increased her majority, and she hit her peak popularity. But she's facing an election with recession, 20% house price falls, and unbelievable mortgage stress, where half of all mortgage holders are going to go from sort of 2% fixed rate to God knows how much. It could be 6%. And, imagine going to an election with that. You're not going to win. So, the RBNZ is actively going to kick out the government, basically.
Well, it's interesting. I don't know whether you had a chance to watch, but I was watching some of the discussions between the parliamentary discussion with Adrian Orr, right, about why and what and who. And you could see some of the concerns bubbling up from the political sphere because they could see some of the implications and consequences of what was going on. But of course, in New Zealand, the Reserve Bank has to take house prices into account when they set policy, not here in Australia, but in New Zealand. And maybe that's one of the reasons why we got a bit of a different outcome.
Yeah, it could be. Yeah, and look, they've the RBNZ's been pretty vocal in saying that house prices are way too high and they're unsustainable. They've got to come down. So they see it as a good thing, and you can see why. Like during the pandemic, you know, if you think the Australian house prices were nuts over the pandemic, New Zealand was another level. They went up about 40%. But they pretty much led the world in house price growth over the pandemic, and you know they made Australia's look fairly modest. And you know, and New Zealand already had more expensive housing than us anyway on a national. So their house prices to GDP were higher than ours before the pandemic hit, and now they're even higher again. So they hit sort of, it was really high. I think it was about close to five times GDP. Again, it's one of those things. I've now got blurry memory because I'm on holidays, but
that's okay.
Significantly higher than Australia.
Yes,
the highest out of the Anglo countries by a mile. Like we're always number 2, but we're way behind New Zealand. And now we might be sort of level-ish because they've fallen harder than us. But, you know, it just got nuts over there. And the Reserve Bank the Reserve Bank of New Zealand has been pretty vocal about it, how they're unsustainable, they're too high, it's intergenerational problems, blah, blah, blah. So they're actively happy to see them come back down to earth. Obviously, it's going to create pain and it's probably going to boot out the government. But, yeah, they seem to be pretty, you know, fairly determined, I'll say.
Absolutely. And I guess there's another point here. With all of this focus on debt going to support the housing sector, and, you know, the debt balloon has gone up. We've got high debt ratios for housing. But that means there's been an underinvestment in other sectors of the economy, because effectively, you know, all the oxygen has been sucked out by the housing sector. So there is actually a consequential impact more broadly on the economy, as well as the direct impact and the consumer impact, isn't there?
Oh, yeah. And so if you, I know you've done this, Martin, so we're sort of, I know we're both talking to the same data here, but if you go back to the 1980, so pre-Basel Capital Accord, so the Basel Capital Accord came in 1988, and that basically, you know, reset weights. It underweighted mortgage lending and said it was wasn't very risky. Banks don't have to hold much capital. Australia signed on to that. Pretty much all the advanced countries signed on to that. But before that came in, basically 2/3 of lending in Australia was to businesses. Yep. And about, I'll leave personal lending out of it because that's been about 10%. That hasn't really changed. But of the rest, about 2/3 was to businesses, 1/3 was to households. And ever since that Basel Capital Accord came in 1980, it flipped. Over time, it sort of flipped. So business lending fell from about 2/3 to 1/3, and housing lending's gone from 1/3 to 2/3. So basically, and I think that was the cause. Primarily was this central bank of central banks, Bank for International Settlements, did this capital accord, which said mortgage lending is not very risky, collateralized, blah, blah, blah. Because of that, you only have to hold, so you got risk weight, back then it was a risk weight of 50%. So what it means is for all credit risks, so for any time you lend money to a borrower, under that accord, you had to hold 8% of capital against that risk. But for housing, it was 50% back then. So if you lent to a business, you had to hold 8%. For a mortgage, you had to hold 4%. And then gradually over time, they whittled that down to 35%. So 35% of 8%. And then it got even more sophisticated in that if you're a big bank and you had these sophisticated systems.
IRB.
yeah, that's it. It got down to where some of the banks, like some of Australia's big 4 banks and Macquarie, were holding like 15% risk weight. Correct. So it's 15% times 8%. So it got really cheap to do mortgage lending. So it started off at, you know, half the price of business lending, and then it went down to like way less than that. So it just meant that banks could like basically lend more money out, higher multiples for a given amount of capital they had, etc. So it skewed the whole system away from productive lending towards this sort of unproductive lending. Now, I'm not saying we need a mortgage system. I've had that forever, but it just got bonkers. And then it just got collateralized in the house prices. So it's just this, I don't know, the law of unintended consequences, I think we can call it. And if you go to that RBA data of the shares of lending to all the different sectors, you can see pretty much from 1988, that's when it starts. And that's when the capital accord came in.
Correct.
And
the deregulation of the financial system and the reduction in the underwriting standards more generally. So all of those things happened, right?
Yeah, that all happened between sort of 88 and 91 with the first financial system inquiry.
Yep.
The Wallace inquiry, I think it was. Yep. I used to know this stuff back to front when I worked at Treasury because I dealt in that. I was in that area. I wrote a paper on and all that. But now, especially being on holiday, suddenly I'm like, my recollection's just turned to
That's all right. You're on holiday. That's fine.
Yeah, like 4 days of. I don't usually drink much, but I've drunk a fair bit, and suddenly out. I've been watching the cricket. It's hot, you know.
Yeah.
Exactly. So now I'm like, to think,
because
I just go, the Ralph, the Wallace review, blah blah blah. But so it's like all these law of unintended consequences. Or maybe it was intended. Who knows?
I was going to say, unintended consequences, or was it a deliberate steer, right? Because those ratios were, of course, very much driven top down through the BIS. The BIS, of course, is very much influenced by, the major financial players, the Fed and other people. So my theory is this was actually quite a deliberate policy, because what it allowed them to do was to expand their balance sheets, chase volume, increase their balance sheets further. Prices went up. That allowed them to increase their balance sheet further. So it was actually a self-inflating machine.
Yeah, and also obviously, had things like the Pitchford thesis, which was like this view that private debt doesn't matter. So this is where like Steve King comes in. But it was like, I remember being at the Treasury. It was early 2000s. It was, it doesn't matter. It's it's between consenting adults. You don't worry about the private debt. It's all about government debt.
Yep.
And we all know that's false. But that was the view back then. So I think all these factors, and then in the 80s we had the whole neoliberal Thatcherism, Reaganism, blah blah blah. So all these sort of factors just meshed together.
Correct.
Top down. BIS did it, and then obviously we had the deregulation of financial systems everywhere. So it happened here as well. I mean, obviously it happened here. Where suddenly credit became really easy, and then suddenly the household debt ratios went up. Like that mortgage lending went up. The share of lending to businesses shrunk compared to mortgage lending, and house prices took off. So it's all this, I guess it's law of unintended consequences when you look back now. And you go, we created a monster.
Yeah,
we created this Frankenstein, and 30 years later you look back and then you go, I wonder if they would have done that if they'd known this was going to be outcome.
Yeah, that's right. And it's interesting, of course, because then they keep finessing it and trying to make it more accurate, and the IRB, and and then of course
it's just fiddling deck chairs and the Titanic.
Exactly right. But what's interesting is that even now, if you look at the Australian banks, the IRB ratios were tweaked a little bit, so they were sort of around 20 and a bit percent now, whereas they got down to 15%, but they're still way low. So whilst everybody keeps saying the banks are wonderfully well capitalised in Australia, they're not actually, not really.
No, it's pretty low. Very low number. If you actually look at the amount of $1 per mortgage they got to hold per $100, it's very low.
It is, exactly.
Excuse me.
And that, of course, is on the assumption that property prices only ever go up, so therefore the chances of making a loss on a mortgage is extremely low, except that maybe the consequences of what we're seeing now with higher interest rates and the debt pressure and everything else, it could start to change the equation. And if it does change the equation, then you start worrying about financial stability. I have a feeling that it's not necessarily just going to be the debt consequence directly, but it's the worry about financial stability, which will be another reason why we might see some interventions from APRA and from the Reserve Bank to try and unwind some of the pressure that's there at the moment.
Yeah, and we've seen it over and over again. Like we know the RBA will backstop the banking system if they need to, because they've done it, how many times now? I used to worry. I used to sort of think about that whole financial stability stuff. Now I don't kind of the only way you're going to get a problem with that is if they make a mistake and they don't act because they just didn't act. They weren't quick enough, which is kind of what you got in the US during the financial crisis. But I think they'll be quick enough to intervene if they have to and give them all that free funding money and all that sort of stuff. But that's not necessarily going to save the consumer, and which is sort of where the pressure point is for the economy next year. And the interesting thing for house prices, I don't know what you think, but it seems to be that the consensus view on Australia's house price peak to troughs about 15 to 20%.
Yep.
Seems to be kind of where most people are. And I actually think that's probably about right. But I mean, we don't know. Like, if someone said, "Okay, Leith, put a figure," and I'd say 15%. I'd just go, "Yeah, 15% is my figure, peak to trough decline." But what we don't know is, will we start getting those forced sales next year? If you've got this massive fixed rate mortgage reset, like, how many people are going to be forced to sell? I mean, that's like, I've got no clues if it'll be bad. But if it is bad, that's when you could start getting it becomes a really messy price bust. So it goes to 25% or something, because, rather than just having this borrowing capacity thing, you then get people being forced to sell with not enough buyers out there, and, they're just forced to take big haircuts. Or alternatively, the banks sell it under them because they can't make the payments, and then they default and whatever. So, that's kind of never happened in my lifetime. We have seen that in the housing market. It's always been a risk, but I think this time it's a clear and present danger. Whether it has an impact, it's probably if I had to say, it's not the central case. People always economists, they're going to give weasel get out of jail stuff, but I'm going to do one now. If I had to tip a number, I'd say 15% peak to trough decline, but there's the 25% chance we get these forced sales and it goes way worse. We just don't know. So it'll be interesting. Like that's going to be something really interesting to watch next year, what the actual impact is on house prices from these, rather than just people's cash flow and the economy and the consumer spending. What's going to be the impact on house prices when the fixed rate mortgage reset comes up? Will people be forced to sell? And I think especially if it's all these first home buyers that are that are struggling.
And my view is it's very hard to talk about an average number, right? Because I think what you will see is very different behaviours in the market, in different locales, with different types of property, with different circumstances. Oh,
for sure. And Sydney's going to be hit harder because it's the most expensive with the most indebted households.
Yeah, highly leveraged. Brisbane, of course, is falling faster than Sydney at the moment.
Yeah, because they went up so much. So Brisbane had the biggest poll on during the pandemic. It went up 45% or something.
And I chuckle because some of the property spruikers are now saying, the rate of fall in Sydney is slowing.
Still very high.
We're sort of nearly there. I'm just not quite so convinced as they are that.
No. So if you look at the quarterly decline in Sydney, it's still tracking at 4%.
Yep.
So which is that's still 12% a year. You're 16%. If you annualise it, like that's always a bit bit flaky if you annualise something that's a quarter, but still it's 4% in there.
If Mr. Joy can do it, we can do it.
Yeah, that's right. But it's that's still 4%.
Yeah.
Like 4% is not. It got up to 7 at 4 months ago or something when it was at its worst.
Yeah.
But 4% is still a pretty sharp rate of decline when you've already gone down nearly 13%.
So just on that, people will say, but we have property prices go up in Sydney 30%, so we're coming back a bit, but we're still well above where we were. I mean, how do you rationalise that?
Yeah, well, I mean, that's true if you bought at the start of the pandemic, but it doesn't matter. Like, we're always talking about the margin, right? So the borrowers I was worried about earlier when I'm talking earlier are the ones who bought, anywhere from 2021 really, but especially that sort of second half of 2021. So they bought near the peak. And for those people, well, it doesn't matter to them that they went up so much during the pandemic because they're down, year on year house prices in Sydney are down 12%. So, those people are going to be underwater.
Yep.
And it's one thing to be underwater, on suffering house price falls, especially once you factor in stamp duty and all the other stuff, which means you've got to have 5% price growth just to break even when you got to pay stamp duty. So those people are already underwater, but it's, those are the sort of marginal borrowers that you worry about. It's always the recent people you worry about. It's not the ones who, I bought years ago. Well, what does it matter to me? It doesn't. and I don't care if my house goes up or down because I'm living in it anyway. I'm going to be living here for decades. So to me, it's a pure. I bought a house for a house, but if I'd leveraged to the gills to buy my first house last year, and suddenly it's underwater 10% if you bought in Sydney, and you're facing a 40+% increase in mortgage repayments if I was variable, but even more if you're fixed and it switches next year. That's where the pressure points are. I sort of don't like that. But I went up this much, and it's only fallen half that, so it doesn't matter. Well, from a risk perspective, it does, and from an economic perspective, it does. So.
Yeah, absolutely. Now, there's another question I wanted to throw at you. The Productivity Commission published a report during the course of this year, and one of the things that they said very clearly was that these first-time buyer incentive schemes were not effective in terms of actually dealing with housing affordability, enabling people to get into the market, blah, blah, blah. So basically they said, stop it, right?
Yeah.
And yet we still have states, including Victoria, New South Wales and elsewhere, still throwing more money into those sorts of schemes.
Shock horror, right? The shock horror. They're ineffective, and they inflate, and they make houses less affordable.
Correct.
Oh, wow. Yeah.
Yes.
Like Steve King was right all those years ago when he said he called it a first home vendors scheme or whatever.
Yes, exactly right. But it does seem to be political, right? And what I was trying to get to more generally was there's this cross current of political stuff versus economic stuff, right? And my theory has been for the last 20 odd years, most decisions have been taken not from an economic stance, but from a political stance. And it seems to me that this is one of the Malaysias that we have in Australia, particularly now. And I suppose you could also talk about, gas prices and the way that that's been politicised too. It's a real issue though, because when politics gets in the way of making sensible decisions, I have a problem with that.
Yeah. Well, I mean, it's a cartel economy. So we've got a property cartel who, I often put it as a joke. It's a bit of a joke, but at the end of my posts, Australia's the property equivalent of a narco state. So so we got the narcos in Colombia and whatever, yes. but we're like the property equivalent of that.
Yeah.
So whenever I always do it in relation to planning and whatever. So we've got these farcical situations where I think the head of the Albanese government's supply council thing is a property council person.
Yeah.
It's like, come on, and then same in New South Wales, where all their like planning czars and all that are all property council people on these positions. So. So we've got a property cartel there, but also, Australians are so geared to the gills with debt that they want something that's going to push up the price of property, or at least, a bit like the old Bernanke put, whatever it was, or the Greenspan put. We want that with housing as well. And then energy's the same. We've got an energy cartel running that. We've got a sort of university cartel now, pushing the students and immigration along with those other cartels. So, we're sort of a cartel economy. I should say a rent seeker economy or a vested interest economy. We've got these like groups like the property lobby, the big business lobby, and the education migration lobby pulling all the strings, whether it's housing, energy, immigration, whatever. And that's kind of just the way it works. It's it's sort of a lobby economy. It's probably a better way to explain it. And it's been like that for as long as, well, not for as long as I remember, but for a good solid couple of decades. So unfortunately, I don't know what the solution is. Because I think all Anglo countries are pretty much the same, experiencing the same stuff. So maybe the system of government, I'm not sure, but. For whatever reason, we're it's all short-term thinking. It's what's politically popular, virtue signaling policy. So something that sounds good but actually is ineffective. So we've seen that with the Albanese governments, building like 25 social houses and saying that it's going to solve the problem. Victorian government's just announced the State Electricity Commission is going to do nothing because it doesn't fix the problem of the coal and gas cartels, who actually set the input prices to all this stuff. You see it across everything. we know that the first home buyer grants and all the other stuff they do is popular because whenever they're always taken up at a huge rate whenever they're bought out, and
Yep.
you know,
Interestingly, they test very well in polls.
yeah, that's it, and it'll be poll driven, or they get their what do they call when they bring in their focus groups, focus group testing.
Yeah.
So and I'm sure they know it's useless, like bad policy. But it was interesting and good to see the Productivity Commission actually come out and call it out. But it's not going to make any difference because the Productivity Commission, I'm not the hugest fan of a lot of things, but I think it was a lot better under Gary Banks in the old days. Now it seems to be politicised. But, it's done this with a lot of things where it's come out with recommendations, whatever, and it's get ignored. And I bet you bottom dollar, we'll get another housing affordability parliamentary inquiry this term. And it'll just be another one to add to the last 20 with it from state governments.
And it'll all be on the supply side, and it'll all be about planning and the states.
The same BS.
It's the state what did it, right?
Yeah. It's the same old charade, and nothing will change. And then, but they want to be seen to do something, and blah blah blah. And we just had one, the supply one last year. We've had so many in the last 20 years, and they never amount to anything. And we'll get another one this year because when the pressure comes on them, they'll be like, oh, we might have a rental one next time. There'll be some rental supply one because that's sort of like the pressing issue at the moment. So there'll be some rental inquiry, and it'll just be a lot of BS, and there'll be build to rent and all this, we need to get more commercial interest in, we need the development lobby to come in and provide rental housing. Something to give kickbacks to their mates, give more market power to the property industry. And it won't actually fix the problem. And then at the same time, they'll ramp immigration to levels we've never seen before and just keep the pressure on demand. So, unfortunately, I know it sounds incredibly cynical, but, I've been doing this for 12 years now, and now that's kind of what I expect. And, I'm almost shocked if you get decent policy somewhere. It's like the $12 price cap on gas. It's third best policy, not great, but at least it was something. And just to have something was like very refreshing because you're so used to just getting nothing or getting policy that makes it worse. So, it was like that was almost a breath of fresh air. And that's because my secret to happiness I've worked out is low expectations.
good,
right? So if you expect nothing, if you
Yeah.
expect nothing and then you get something, even though it's not that good, you're like, wow, that's awesome. Because if you expect nothing, that's the way to stay sane.
Well, I had Carl Murray on the other day, and we were talking about, game of mates, and the fact.
Oh yeah, good guy.
Yeah, very interesting conversation, and concluding somewhat similarly that actually there's a bunch of stuff going on below the waterline, which means that you don't get good policy decisions because there's other vested interests pointing in a particular direction, and that's part of the issue I think that we've got here. That it's very unlikely that we're going to get good policy. Simply because there are too many people who actually want to expand big Australia, who want to build more stuff for the sake of building more stuff, never mind if it's, very small dog hutches and what have you, right? And we sort of miss the big picture. And my joke is I wrote a report, 10, 12 years ago for one of the submissions in one of the inquiries, right? And every time they actually ask for another inquiry, I just dust off it and change the date because nothing has fundamentally changed.
No, and just on that, it's not just they're really frustrating. And we've seen this twice in the last 6 months since this government came in. It's not just the vested interests who are doing what lobbyists do. It's the fact that whenever you try and when you're hoping for good policy, the opposition will just say no. So, classic example: when the Albanese government got up during the Jobs and Skills Summit and announced this insane big Australia immigration policy, like the biggest ever. So a lot of people just focus on the permanent migration cap that's going to a record level, but it's also all the stuff they did around temporaries that's just going to open the floodgates. And then what was Peter Dutton, who ran against immigration when he was in government as in the background, said, oh no, we need more. So that was his, they asked him about it. He goes, oh no, we should have had more. So it's like, well, so there's no opposition there. You got the guy just saying, they didn't do enough. And then you've got, classic example with the energy stuff. The Albanese government finally does something. brings in an incredibly generous $12 price cap, which is set 50% higher than the gas price was a year ago before Russia invaded Ukraine, which itself is, the ACCC says the cost of extracting gas is about $5 a gigajoule. So it's like, more than double that. Incredibly generous. And then the coalition, like Dutton comes out and says, oh, this is terrible. Like we got to, we oppose the cap. We oppose intervention. It's going to restrict supply, blah, blah, blah. So it's, is there any wonder we get bad policy when instead of Dutton come out and say, no, $12 cap's too high, it should have been 10 or 8, whatever it is. He instead says, no cap. And he's stuck to it. Like he's just basically sided with the cartel. And is there any wonder we get bad policy when the opposition party always opposes good policy? So we saw it when Labor went for the 2019 election. They had some decent stuff around property. Well, coalition came out, scare campaign, blah, blah, blah. Labor had some outrageous policy with respect to immigration then in that campaign with unlimited parental visas for elderly migrants. But, the coalition came out and opposed those reforms. And then now the energy cap, they oppose that. Labor comes out and announces record immigration. Oh, but no, we need to have more. So it's like, there's no wonder we get bad outcomes because two parties can't just put their politics aside for 1 second and govern in the interest of the people they represent. It's all about scoring a cheap political point.
We should remind politicians that we voted them in and they're actually working for us rather than the other way around, right?
Yeah, but the whole thing is like, often people go, oh, why'd you vote for, if you're not like this, why did you vote for Labor or whatever, It doesn't matter because all three, the major parties agree usually, in case of immigration, for example, they're all on a unity ticket. Yeah. So it's like, it makes no difference. Like, it's a false choice you've got because I haven't voted for one of the three majors for, I don't know, 15, 20, I can't remember the last time. It was a long time ago. I used to have a lot more hair, like thick hair when last time I did it. But it doesn't matter. Like I vote for these minor guys, but their preferences still will go to the big guys. So, like I always put, for me, it's always a battle about who's going to be my third last, second last, and last. And whoever's the third last is going to end up getting your vote. Yeah. So even though you put all these other ones before, it's still eventually going to go to them. And that's the choice that Australians have got. We've got these sort of false choices because you're not given a real choice because these parties won't, when it's a good policy, the other ones won't support it or they won't try and improve it to make it even better. They'll just oppose it. And when it's a bad policy, they'll demand an even worse policy. So it's just, throw your hands up. It's just, unfortunately, that's the system we've got.
It is the way it works.
Yeah.
Now, here's a question just for... We've got time, I think. So will Australia end up like parts of the US and England with extreme slum areas? And that's the wealthy versus everybody else, the degradation of some areas because, of course, we find that there's a concentration of debt. My short answer is I think that's quite likely.
I think we already got it in places like Sydney.
Yep.
So if you go to Sydney, and not just, I don't want to be one of those guys that harps on the immigration issue all the time, but it's very, they always call it the latte line is when they talk about it. But there's the disparity between the northern beaches and the inner east between the rest of Sydney is unbelievable. So, the poor guys in the west, they're stuck with a crap climate. Well, it's stinking hot in the summer, like searingly hot. Winter, it's cold. Everyone living on the coast, like right on the beaches, really close to the coastline's got, a nice climate. All the development's been forced into, there is some high-rise development near the airport and whatever. But in terms of most of the migrants have been pushed out in the west, far away from the city in these extreme heat areas, where they've got bugger all infrastructure, sardine can living, postage stamp-sized lots, whatever, or dog box apartments and then they're stuck paying egregious tolls if they have to go in the city for work, whatever. And there already is this sort of haves and have not. So Sydney's a great place if you're an elite, like a beautiful place. If you can live in, Port Clues or, Dover Heights, all those sorts of Double Bay, Manly, all those, the northern beaches, all that stuff, fantastic. But you've got to be uber rich to live there. And policies, and all those areas have basically banned development in those areas because they want to keep it the way it is. But they also, their politicians are the same ones that support big Australian immigration, as long as it's not in their backyard. It's got to be out west. And, so we've got these sort of Western Sydney slums where people are struggling. They're living in cramped conditions. They got the heat up. They got the heat stress in summer because it's boiling hot. Got to run their air cons all the time. Nobody can play out in the streets. It's too hot. All that sort of stuff. There's no playgrounds anyway to play in. There's no nature strips. This sort of really bad quality of life, while the elites in the East, they're the ones who make money out of this stuff because they own the companies. They're the capitalists. So I think we already are kind of seeing this this segregation in places like Sydney, and it's not so bad in Melbourne. It is to a degree down here, but it's not as bad. But like Sydney is the epitome of this kind of economic model, I think. So yes, I think the short answer to your question is yes, and we're going to see more of it if they keep this up. And if Sydney goes to projected 9.5 million people by 2062, I think it was, according to the ABS, and Melbourne's supposed to go to 10.2 million people. So two cities roughly the same size as London. You're going to see segregation like we're not believe. And the Urban Task Force did some projected modelling on Sydney's housing stock. And at the moment, in 2016, at the time of the 2016 census, I haven't seen the updated modelling. 56 of the homes in Sydney were detached houses. Apartments were 25%, and the remainder were townhouses. By 2056, which is what the Urban Task Force looked at, only 25% of houses in Sydney were going to be detached houses. 50% were going to be apartments, and the rest were going to be townhouses. So basically, you look at the situation by mid-century, only 1/4 of Sydneysiders will be living in detached houses. And you can bet your bottom dollar it's going to be, you're going to have to be uber rich, or you're going to have to be very wealthy to live in a house by then. And that's going to bring this, two-speed city into account, where you're going to have the privileged people in those northern beaches, inner east, nice areas, which are basically banned from development. You're not really allowed to go and bulldoze a house and put apartments there because it's all planning restricted. And you have to be uber rich to live there, while everyone else is piled in dog box, Meriton dog boxes. And that's kind of the future, I think, awaits places like Sydney. And it's one of the reasons why they're all leaving, or a lot of them are leaving and going up to Brisbane. And that's just going to put pressure on Brisbane or South East Queensland. So they're going to push on one side of the balloon and it's going to pop out the other. So yeah, I guess it's a long-winded way of saying that I think we're already there in some places in Australia, and I think it's going to get a lot worse over the next generation or so.
Yeah, I fear you're right. Unfortunately, I'm seeing it in my surveys already, and we're a long way from the end of that journey. Unfortunately, it's a journey that has been set by those who actually are on the more affluent end of the spectrum and are able to pull the strings, and and shelter themselves from the consequences. Absolutely of that. Right. Yes, indeed. And then actually want more people to come in to be able to feed the machine.
Yeah, and also so they can get their. So it's all about I want to be able to get my Uber driver to come out and give me deliver my food for me. Or, I want to be able to go to a cafe. They get annoyed. I was annoyed because the cafe's got reduced hours. Because they can't get I'm like, it's really an issue. Who cares? Like, cook your own food, make a coffee at home. That's what we used to do. And the hilarious thing is, so I live in a suburb called Ashburton in Melbourne, and it's a really nice area. Like, it's when I was growing up, it was, I don't want to say it was poorish, but it had a bit of housing commission, whatever. But now it's all like upper middle, big blocks, houses, low density, whatever. It's like, it's a really nice place. There's this street, it's called High Street. So it's one of the best strip shops in Melbourne. And when I moved here in 2006, there was 4 cafes in that strip. Now there's, I haven't even counted. I should go up there and count tomorrow because I haven't been up there I haven't bothered to count, but there's at least a dozen and probably closer to 15 cafes now in a strip shop of, 150 metres probably. I'm like, it was fine when we had 4. 4 was enough cafes. Why do we need 15 or 12 or 15 cafes? And then the other thing that's exploded is bloody massage parlours everywhere. Who goes to them? Like, every strip shop in Melbourne now, there's a massage joint. And I'm like, is that money laundering? Is it immigration scam? What is it? And this is like, there's just been an explosion of all this stuff. And you're like, well, why do we need 15 cafes or 12 cafes in a small shopping strip when 4 used to be fine? And then if people want to whinge about, gee, I went to my cafe and it was like only open until 4 o'clock, and because they can't get staff, we need to go and bring people in overseas to work in it. And so it's like, mate, just make yourself a coffee. Not a big deal. Or maybe cook yourself a meal. It's a lot healthier for you and it's cheaper. But yeah, these the elites seem to want to keep bringing people in so they can have these sort of low-skilled servers for them, and they can get their stuff cheaper. It's kind of ridiculous without thinking about the consequences of it, rental market and all that other stuff. Anyway, sorry, that's a rant.
No, it's a good rant.
I think you're pretty good on the rants tonight.
Well, that's right. This is a ranting zone at the moment. We had a rant last night, and we had a rant tonight. Somebody said we had 2 property rants in 2 days. That's fine. We've pretty much come to the end of the show. So just to recap, what you're saying is that next year probably a recession per capita, but not a real recession, simply because of the migration and because of the policies that will actually be there to blow the balloon up a bit bigger.
Yeah, so I mean, it's kind of the situation we had in the previous 10 years. We didn't have a recession all the time, but Australia's actually had quite a few per capita recessions in the last 15 years leading up to COVID. So when you look at a per capita GDP chart, you can see. But we didn't have a recession in aggregate terms because we just had such high immigration. And I think we've got to get that again next year, where it's going to be a pretty crappy year. Like we might get, we might eke out 1% economic growth for the year, or I think the RBA is tipping 1.5%.
Yep.
Which I think is probably a bit generous. But if you're getting 2% population growth, that means you're going backwards per head. So I think we're going to have one of them. I think we're going to have a global recession, or at least a lot of the other advanced countries are going to have a recession. I mean, the Reserve Bank's already called New Zealand recession. US, I think's very high chance. Probably Canada as well, and a couple of England's already in recession pretty much. So I think the developed world's going to be in recession anyway, and I think we're going to have our own different kind of recession, just because we're going to have probably 2% population growth. So and unemployment's going to very likely rise as well, because one of the reasons that kept unemployment has dropped unemployment to 48-year lows is because we did lose a lot of migrants over the pandemic, and so effectively the stimulus created jobs, but those jobs went to unemployed Australians rather than people who just were brought in. And now that's reversing at a real rate or not. So even if other things equal, unemployment should rise, just because labour supply is going to rise very quickly. It's already started to tick up. And when that happens, we're going to have higher unemployment. It's just a reversing of that, the impact we had over the pandemic where migration turned negative. Well, now it's going to turn record positive.
Yep.
So the labour force is going to grow very quickly, which means that if you don't create tons of extra jobs to soak up those people, we're going to get rising unemployment. So it's going to be for a recession for all intents and purposes, except the government will be able to claim victory because, look, Australia dodged recession again because of our superior economic management when we just inflated the population balloon.
Exactly.
Which is pretty much the state of play in the previous 15 years. Like that was the reason why Australia dominated.
Correct.
Australia's just great. We're such a great economy. It's like, well, not really. Like if you grow the fastest in the developed world through population growth, and you grow it, 3 times the rate of the OECD average, well, then it's going to be a lot harder to have a recession. If you just measure the total pie, that's all you're measuring, not everyone's slice. It's quite hard to have a recession.
Yeah.
So that's basically it in a nutshell.
Yeah, cool. Well, I appreciate that.
Long in a nutshell.
Thanks very much indeed for sharing your thoughts tonight. Really appreciate it. Now, I did actually ask the chat. Will probably be in recession by the end of 2023. 63% said yes, 18% said no, and 20% said can't say. So that gives you a bit of a sense of where the community is on the stream tonight, which is quite interesting. So I want to say thank you very much for that. Refer people, of course, to MacroBusiness. We'll put links and things below where you vigorously defend these positions as you do on a regular basis. So thanks for that.
Yeah, it's going to be a little bit light for the rest of this week. It's going to be light, and then I'm back next week. So for a week, and then Dave's back, and so just this week it's going to be a bit light. That's all. Like Chris is going to write some stuff, and I might write 1 or 2, but just this week. So if you go there and go, hang on, there's not much, it hasn't changed for a few days. Well, that's why.
Yeah, well,
just for a couple of days.
We are in an interregnum between Christmas and New Year, so it's perfectly explained. And of course, there's no economic data, and the markets are closed, so it's all a bit quiet. But
and it's pretty much the only time of the year where we can Dave and I can both take a break at the same time.
Absolutely.
And Chris as well. So we're like, this is the one time where you can just like, okay, we're not going to worry about it. For 3 business days, like today's public holiday, we can get by.
Yeah.
We're just doing only a few minor things.
Well, I want to say thank you for breaking your holiday to come on the show tonight. I really have appreciated it. Enjoy the conversation as always. And we'll do it again in the new year, and I'm sure we'll compare notes as the year progresses.
Oh, yeah. Look, it's guaranteed to be another interesting year. It's going to suck
exactly right.
in some ways, but as for someone like Martin and I, this is pretty much our job to watch this stuff and commentate and, sit there with popcorn.
Yeah.
2022 was fantastic for that, even though it sucked in other ways. But 2023 is shaping up to be the same. Just really interesting time to be alive if you do this for a job.
Absolutely.
Honestly, this is probably last year and this year, or the year coming, will probably be the best 2 years in 12 years it will be of doing this in terms of, just the dislocation, because we weren't doing this in 2008 when the GFC hit. So, this is kind of a historical moment for us, where it's so interesting because there's never before seen, synchronized rate hikes and it's energy crisis and all this other stuff happening. Yeah. And obviously inflation crisis we haven't had since the late 80s. So, it's really interesting time. Going to be a good year. Oh, well, interesting year, not necessarily good.
I was going to say, good may be the wrong way to describe it, but certainly interesting.
Well, fascinating.
And fascinating from an economic point of view and from a, a policy perspective. Yes. Interesting to see how it's going to play out.
Interesting is the way to
absolutely
better way to phrase it.
May you live in interesting times, Leith. Thank you very much. Have a wonderful new year, and we'll pick it up again in a little while.
Yep. Thanks, Martin. And thanks everyone watching, and have a safe new year.
Cheers. I'm going to take you offline now, and I'll close the show. See you later. There you go, folks. I hope you enjoyed that. Very interesting conversation and plenty to explore there. Just to tell you that next week I've got Damien coming on, and we're going to talk about investing in 2023, the outlook and all those sorts of things. So that's, if you like, the other complete part of the puzzle. So watch that. Also, just a quick look on the doggy cam. The dogs are completely zonked now. I will be taking them out for a bit of a walk a bit later. But they've been hardly moved at all. In fact, the whole of the time that we've been talking. So that's Meteor completely zonked. And the Luna, the other one, is also pretty much just looking as though they're completely out of it. So there you go. So thank you very much. I hope you enjoyed this show. I wish you the very best for 2023. There will be another live show next week, of course, and there'll be a couple of other shows that I'll be making over the next couple of days. In fact, I'm talking to Adam Stokes in the next couple of days with regard to cryptos, but that won't be a live show. That'll be a recorded show. So I'll look forward to seeing you next Tuesday, and check out the recorded shows. Meantime, this is Martin North from Digital Finance Analytics, signing off. I'll see you next time. Cheerio.